Today we're just going to review Bequest Funds. This is not any investment advice, just more of a breakdown of what they're offering and what's involved here. So Bequest itself, this is their website. They say they're offering 8% annually on reperforming residential mortgage notes, and they have a diverse portfolio. Something that's interesting here, they have this focus on basically providing a consistent way of getting 8%. It's nice, easy, fixed model, obviously with compounding interest, SEC regulation. This is going through a 506 regulation, and it's a continual fund, which means that when you invest in this fund into Bequest, it means that you'll have a 2-month wait period to ensure that the funds that you've provided get added to their fund, and then you'll start making your 8% yearly compounding. After 1 year, you have the option to exit. There is obviously some criteria around exiting, which you can read into, but in general, at the end of the year, you can exit. So what is it that you're actually investing into? This, I would say, is a good fit for someone that doesn't want the hassle. They just want to get an 8% return with a consistent payouts, which are monthly. So if we take our calculator here, just quickly, after your initial investment, let's say we're putting in 10,000, we make our 8%, ignoring the 2 months, we're going to be making $6,606 every month. So they're going to be paying back our interest. It's very good, but what does all this other stuff mean? Let's go through a couple of their documents here. So we have our executive summary, standard disclaimer. You know, they're saying that this is just kind of not, it's a 506c, and they just present the factual manner, but obviously they can't claim results. So what are you actually investing into? You're investing into a residential mortgage fund, which is debt-based security. That means, in simple terms, is that they're going out and they're buying mortgages, retail and, business and other retail mortgages, because this is from a lender. The lender itself is going to most likely have UCC filings and liens against the properties, which means that this investment is generally backed by the property itself. And, they've spread out their risk among multiple parties, which just means they're not affected by, if a single property had a problem paying back its mortgage directly, you're not going to be affected by that, and they're controlling and mitigating risk. So it's a simple model. Going into further details, they go into why it's a fairly high yield and low volatility is because obviously the way they're distributing the risk. Here they classify themselves as asset-backed, which is the properties. It's liquid, which means because it's a debt instrument and they're getting their payments, loan payments are going to be received maybe weekly or monthly or quarterly, but they'll be receiving regular payments. It's not going to be like an interest that you get from an equity at the end of the year. Tax efficient, so simple tax, low leverage, so they're not heavily borrowed funds, and as great diversification, so it's all split up. Now looking at here the notes that they purchase, 11 to 15% yields on residential, on asset-backed hard money loans, and business notes. So they're purchasing these types of notes from financing. The yields here 11.15, 12.18. The yields are fairly standard in the market from my experience. And the default rates at 10% or less. So default rates means that one of the customers cannot pay back something. So they're saying that during that period of time, they're going to struggle to pay back something. So it's very common that there is some type of default rate related to these loans. Life is not perfect. Something will happen. You'll lose your job, or business will collapse, or whatever. So you would expect to see some kind of default rate. And that's not a bad thing. That's just a common thing that you're going to see. So obviously the yields are higher than what they're paying out, but also they have the management overheads, they've got default rates overhead, and here they're claiming to claim back a recovery rate of 100%. Now, I'm not quite sure if that's recovery rate of the capital plus interest or just the capital that they're commenting here. But either way, obviously that's a great thing to be able to do to recover back your, even if it's just principal, it just means, that would be a pretty great rate if they're achieving this 100%. As I said, it's non-variable instrument, so 8%. It's very consistent and just, it's a great way to place your money into something like this if you wanted kind of a safe place to have your regular paybacks. Other things that they talk about in their document is the pandemic. We only purchase reperforming and performing mortgages, so these borrowers are still paying. Retail has taken a hit. We buy and sell residential real estate is pulling the country out of the pandemic. So that's their claim. The pandemic is currently, going through its stages. Obviously, everyone has their own opinions, but the market is indicating that real estate is still growing in multifamily and other areas, so it seems that claim is backed up by factual information regarding growth stats and things like that. And I'd recommend, if you want to look at multifamily kind of growth stats, then you'll be able to see that this is a growth industry. Minimum in this document is incorrect because the minimum they're offering is 25k. This is the simplified version: alternate income funds in secondary mortgages, residential mortgages, asset backed, and business notes. Essentially, they're buying notes and selling notes. So what are they? Promising notes. You can kind of consider this like a IOU money. So you receive the contract, they've signed on their side that says, we agree that we're going to spend, pay 8%. The notes that they would be buying are probably a little bit more complex because they're going to have clauses in there regarding the assets and, as I said, liens and filings against them. It means that if something happens to this mortgage, is that in this note that they've purchased, they're going to be able to go out and try to recover. The company went bankrupt or the resident couldn't pay back their mortgage, because they have that filing, the bank might go in there, sell the property, but with that filing means that you become one of the priority people because you own this note to receive that funds in the case of liquidation or bankruptcy or something like that. So that's a good thing to know. Once again, default rate less than 10%. That's a great number from my experience. I've seen default rates around 10%. So proprietary underwriting model. What underwriting means, I cannot talk about the Bequest directly, but in generally that's going to mean that they're not just buying the note willy-nilly. They're going through a process to evaluate most probably the developer and looking at their background. They're probably going to look at the property and see its actual value, do their market research, do history like credit card checks and criminal checks and things like that to ensure that where they're investing is a stable investing. Obviously it's proprietary, so we're probably not going to be able to access how they do this, but with these kind of stated rates, obviously it must be a fairly reasonably strong underwriting model. And there's a little bit more details about the management team: 20 years experience, Fortune 500 companies. Once again, another 20 years experience here for Martin and Sean. And the way they offer is an interesting model, consistent returns, and only as self-opinion. It seems like not giving any advice, but it does seem like a strategy of, if you have that capital, that you want somewhere to place for a period of time to earn kind of that 8% compared to a savings account or something like that, it seems like a good option with that regular income and things like that. Obviously this is all US based, so that's probably important in terms of collections and collecting on debt and legal action that can be taken in the case that they can't pay in terms of recovery rates. So all in all, this is Bequest. Their model is very different out there. It's non-variable. They're putting the effort to distribute their portfolio to ensure the risk is mitigated, and obviously your success and their success are intertwined. They're not getting any extra revenue by anywhere that's going to negatively impact you. And compounding, so options available. So I assume that's something you need to discuss with them to go forward. So that's a Bequest offering, and it's a very interesting offering. And I think it's a great short-term alternate if you are unsure where to put funds or what to do with funds in the short term.